Welcome to the Analyst View by Capital Group, a podcast series that offers concise, investment-centric dialogues. In each episode, they'll deep dive with Capital Group's analysts to bring you focused discussions on sectors and themes shaping the investment landscape. Straight to the point conversations designed to provide you with the knowledge you need. In this episode, Investment Director David Polak speaks to equity investment analyst Nathan Meyer about the changing face of the media industry. They look at the growing dominance of streamers in the television world and how Nathan's focus in video games has shifted from game creators to platform companies.
Nathan, thanks for being with us here today. And I wanted to dig into your coverage in a couple of ways. Start with what we've sometimes referred to as the streaming wars, but then look at another area of media, which is the gaming industry, and are they connected and how do they relate? So to begin with, the question I would have is, did Netflix win the streaming wars? And if they did, how did they do that?
Yeah, well, thanks for having me, David. I can talk Netflix and video games all day, so happy to be here. And I think, in short, yes, but I've always taken some issue with the framing of streaming wars. War implies destruction and zero sum, where Netflix I think of as more leading and capturing most of the value that occurred as TV transitioned from linear TV ecosystem where you had a very high price, very inflexible packaging, lots of ads. And then Netflix led the transition to streaming, which is more choice, lower prices, and lower ad loads. And so I think that was something investors missed amidst all of the competitive headlines with new entrants coming in, where this was a decade plus long structural transition where it was not a zero-sum game. So streaming has gone from 0% of TV viewing 15 years ago to north of 50% in the US. And Netflix has over 300 million global subscribers, on pace for $45 billion in revenue, $13 billion of operating profit. And just to compare that to peers, Netflix has over half the revenue, over half the total industry revenue and industry engagement, and then about 90% of the industry profit pool. And they got there by, they had an early start in streaming. They expanded globally first, and then they had the better technology, but I think also very importantly, they had a management team that was very focused on streaming, and they were mostly competing against companies that had multiple different businesses, broadcast studios, cable networks, movie studios, theme parks. And so I think that the focus was also very important in Netflix's success. So I think that's kind of where we were and where we've been. But if we look forward, I think Netflix is at an interesting point now where, again, streaming is now over 50% of TV viewing, that this structural growth will eventually slow down.
Yeah.
And so while Netflix won the war, if we will, for streaming, the broader battle for consumers' time and attention is very much still a competitive one, because you have user-generated content like YouTube, TikTok, which is rapidly growing, taking share of consumers' time, same thing with video games. And if you look back over the last 4 years, companies like YouTube and Roblox have grown engagement faster than Netflix. And so I think that's why you've seen Netflix start to take and they've always had a broader lens on their competitive set and say, well, we should start looking at doing deals with creators like Miss Rachel and licensing and developing our own video games to start to tap into some of those broader themes in media. And so I think that'll be an interesting point to watch going forward, is can they be successful in those endeavors and continue to sustain the engagement growth that they have going forward.
Thanks, Nathan. Super interesting. Clarifying question before we move more fully into gaming. You mentioned that streaming is now more than 50% of the viewing market in the US. What does it look like outside the US, and are there regional differences?
There are definitely regional differences. You have some markets where streaming is actually further evolved, like the Nordics, where you had high broadband penetration and a lot of the local media companies moved to streaming earlier. So in those markets, you'll see streaming as a share of total viewing more than the US. The UK is probably roughly around the same ballpark. And then Western Europe is anywhere from a few years to several years behind the US. And then you have other markets, emerging markets, where there really is a more of a mobile first mindset, where like India, where there is some linear TV, but a lot of the growth is in mobile only streaming. And so the market looks very different in all the different geographies around the world.
Thank you. And for the listeners, they won't see the difference, but I can assure you that Nathan and I come from, let's just say different generations. And we've had a number of conversations which normally go along the lines of, I'm uber focused on viewing. And so that's where I talk about the streaming, taking over from linear TV, etc. And then I stop there. And Nathan points out, as he's already done so, that there's actually a lot going on outside of what my generation has been consuming. And gaming is one of those areas. And if we could start on gaming, you once told me some, at least to me, astonishing stats about the number of people who are involved in gaming, and the one that stands out in my mind are the number of people who will go and watch other people indulge, if that's the right word, in gaming themselves. So do you want to unpack some of that?
Yeah, I think it's definitely something that continues to surprise people when a lot of the headlines focus on the box office in the US or even the media industry in the US. And those are big markets, but if we think about the broader video ecosystem, TV ecosystem, round numbers, $400 billion globally. About half of that is what we call pay TV and paid streaming, where consumers pay for a service. The other roughly half of that is advertising. And if we compare that to the video game industry, it's actually half that size. It's already $200 billion, and it's been growing at a faster rate over the last 10 years, somewhere in kind of the 4 to 6% annual growth, whereas the whole TV industry has been in the 0 to 2% range.
Wow.
And so it's been closing that gap, and I think the video game industry will continue to close some of the gap with the total market size of the video market. And that's really driven by pretty powerful demographic tailwinds. If you think about kids under 13 today in the US, 80% of them will play video games regularly. And that compares to about half, or some studies of 60% of US adults who play video games regularly. And so you have more of the younger generation playing, and then you're also seeing people who grew up gamers, so like me, are playing longer. And so even though I have a wife, kid, dog, house, job, I still carve out a little bit of time to play video games for myself. So those are, and then you layer on top of that video games continue to improve in quality. So if you compared the graphics of video games 10, 15 years ago, they look a lot better. The games are getting bigger and bigger as technology improves. And it's just a great consumer value proposition. If you just compare the cost per hour of entertainment, it's much lower than traditional media. So you have very powerful structural forces that will continue to, I think, drive the industry to a pretty healthy overall growth rate.
And talking about the cost per hour, what are the differentials there, roughly speaking?
So if you think about using TV as a benchmark, it's anywhere from 50 cents to $1 an hour of overall entertainment when you're talking about the big bundle. And then if you think about Netflix is kind of in the 20 to 30 cents per hour of entertainment range. And then video games, it will depend on the platform. And back to the market size, that 200 billion is about 100 billion mobile, and then the rest of it is about half console, half PC. Mobile gaming monetizes anywhere from 5 cents an hour to 25 cents an hour. Console gaming is a little bit higher, but overall it's still multiples lower than the pay TV ecosystem, which is kind of in that $50 to $1 range. And again, these are all US numbers.
No, thank you. That supplies really interesting context. You've talked about the industry moving from purely focusing on content development towards developing platforms as their key drivers of profitability. Can you develop that thesis a little bit more?
Sure. So a lot of the investable market cap when I first picked up video games in 2017 were what I call the content companies. So companies who primarily made money by making big gaming franchises. So we're thinking about Activision, Electronic Arts, Take-Two, who make most of their money from big franchises like Call of Duty, Grand Theft Auto, EAFC. So those were really growth cyclicals. You had this nice structurally growing industry, but with the games launching every year, every few years, you had these kind of lumpy earnings patterns where if a game was delayed or maybe the iteration of the franchise didn't resonate as well, a lot of short-term investors would sell the stock because they knew that year was going to be bad. And that gave us as long-term investors opportunity to come in and say, hey, do we still believe in these franchises? Do we still believe in the management team? And then we could buy when other folks were selling, and then generally, these were well-managed companies, and the franchises generally endured. If you think about Call of Duty, EA, FC, Grand Theft Auto, these are all multi-decade franchises. And so our framework for my first 5, 6, 7 years investing in video games was just to kind of buy the content companies when something went wrong, and then ride them when inevitably things improved. But earlier this year, I kind of took a fresh sheet of paper because we had some new companies come to market over the last few years, what I classify as the platform companies. So these are more software companies that help game studios create, acquire, and monetize their users, mostly in that $100 billion mobile game industry. And we're thinking about companies like Roblox, Unity, and AppLovin. And I took a fresh sheet of paper to these companies earlier this year and said, over the next 5 to 10 years, where do I think more of the growth and value is going to accrue in the industry? And my hypothesis is that more of the value will accrue to the platform companies. The game engines are going to get better to where more studios are going to be able to make more content. And so you're going to have a more diversified supplier base, which then means more of the value will accrue to the platform companies that supply that growing base of studios, and also to the advertising networks that are able to aggregate all of those marketing dollars, and then also to help those companies monetize their ad inventory. And then the other part of the thesis was these companies were just starting to see some powerful network effects take off. And I think that's most encapsulated by Roblox, which is we can think of it as effectively YouTube for video game companies. It's a very easy to use platform where independent studios, who are often teenagers or people very early in their career, can use this very easy to use game engine to make relatively simple but increasingly more complex and sophisticated games. And then Roblox will help you do that very efficiently. They'll help you market the game and monetize the game. And Roblox is getting what I think of as critical mass, where there's 100 million active users using the platform. And then that growing user base is attracting more developers who are going to come to the platform, make more content, and that content will attract more users, which will in turn eventually attract more developers. And so you could kind of look back to the early days of YouTube or even Meta and see those network effects really taking off. And I think that's kind of what we're witnessing with Roblox now. And there have been some really interesting developments in the last few months even, where this game called Grow a Garden, which was made by a teenager in a few months or even a few weeks reportedly, and millions and millions of people are playing this game every day. And a lot of it is outside of the US. So more people are playing this game than play Fortnite or Call of Duty even. And I think it just really encapsulates the power of that platform. And then if you kind of extrapolate forward and think about the graphics improving, the software tools improving, potentially with some generative AI capabilities to speed up the production, I think it's going to be a really powerful platform and probably one of the most interesting assets in the media ecosystem. And so I think that's been really interesting to watch, and I'm really excited to see where it goes over the next few years.
So if I were to go on to Roblox, I'd be finding games that are produced by independent studios. I wouldn't find Call of Duty. It's not an aggregator in that way.
It's not a aggregator for the entire market.
Right.
It's specific to Roblox, where you use the Roblox engine to make a game for that platform. Unity or the Unreal engine, on those game engines, you can make games that go across all platforms. But Roblox is effectively a closed ecosystem where if you make a game on Roblox, it stays on Roblox.
Interesting. And so when you think about the investment opportunities over the next 5 to 10 years, where do you've mentioned that you like the platforms, are you exclusively investing in those, or do you see opportunities in some of the gaming studios as well?
I think there's still going to be opportunities in the gaming studios, but I think of those as more growth cyclicals where you have to be, we are long-term investors, but I think you can add value there. You buy kind of when people are too pessimistic about the next game or a game is delayed, and then you might want to trim when the market gets excited about an upcoming launch. And so I think that framework will still hold. But if I look at the platform companies, I think it is a little bit easier to kind of say over the next 5 to 10 years, these are going to be much bigger businesses that extract more value from the ecosystem. And so in some ways, they're a little bit easier to invest in because you are just underwriting that theme. And you don't necessarily have to worry about, is the next Battlefield or Grand Theft Auto going to do as many units as the market expects. You're just investing in a platform, and then the content creation is kind of outsourced to the forces of capitalism out there, who developers come make money by putting games on the platform. And so you don't really have to worry about timing the content cycles.
Excellent. Nathan, thank you. It's always interesting listening to you talk about this industry. For me, it's always eye-opening, and I suspect that's true for many of our listeners. Thank you again.
No, thank you for having me.
The Analyst View is brought to you by Capital Group, one of the world's largest and most experienced active investment managers. If you like what you heard today, please follow us on your favourite podcast platform, as well as LinkedIn. Thank you for listening.
EAFC stands for EA Sports FC, which is EA's flagship soccer game. Unity and Unreal Engine are two of the main game engines, platforms for creating video game content. Linear TV ecosystem is the traditional scheduled television model, where viewers tune into content broadcast at specific times on channels as opposed to on-demand streaming. Ad load is the amount of advertising shown during a program or on a platform. A lower ad load means fewer ads, which is often more appealing to viewers. Broadband penetration is the percentage of households or individuals in a region with access to high-speed internet. Higher penetration supports streaming and gaming growth. Growth cyclicals are companies whose growth is tied to cycles, such as product launches. Their earnings can be volatile depending on timing and success of new releases. Game engines are software frameworks used to build video games. Examples include Unity, Unreal Engine, and Roblox Studio. Network effects refers to a phenomenon where a product or service becomes more valuable as more people use it. For example, more users on Roblox attract more developers, which in turn attract even more users. Critical mass is the point at which a product or platform has enough users or content to sustain growth and become self-reinforcing. Generative AI is artificial intelligence that can create new content, such as images, text, or code. In gaming, it can help speed up development by generating assets or environments. This content is intended to highlight issues and be of a general nature. It should not be considered advice, an endorsement, or a recommendation. Products mentioned are not an offer of the product and may not be available for sale or purchase in all countries. All investments have risk and you may lose money. Past results are not a guarantee of future results. Statements attributed to an individual represent the opinions of that individual as of the date published and do not necessarily reflect the opinions of Capital Group or its affiliates. This content is published by Capital Client Group, Inc. and copyrighted to Capital Group and Affiliates. 2025, all rights reserved. For more information, including our detailed disclosures, visit www.capitalgroup.com/global-disclosures.